All right, we still got some people coming in, but hello everyone, and thank you for joining us today for our third quarterly call of 2025. This call is being recorded and will be available to rewatch by visiting our website, clicking on the resources tab, and then clicking quarterly investor call. Just before we get started, we must remind you that the purpose of today's call is educational, and the material presented is publicly available information from sources believed to be reliable. The information in this presentation may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice or recommendations to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. Please visit our website or YouTube channel to view the recording of this call or any other previous calls. Oh, Dom, I think we double clicked. And we lost our function. Hold on. There we go. Okay. Before we get started, we'll just go over today's format. So we'll follow a similar format as our previous quarterly calls with a few prepared topics and then an open Q&A session to end things off. I'm joined by Dominick and Peter today, who will be taking us through their thoughts on some historical acquisitions that have occurred in companies that we've owned, along with some more recent acquisitions and some examples of acquisitions that have failed. After that, we'll get into the open Q&A session. Just as a reminder, you can type your questions in at any point throughout the call using the chat feature. We don't have the ability to open the lines per se due to the call being live and recorded, but this will be made available on our website later tomorrow. Just getting into things, so management teams play a very vital role in the capital allocation of a business. Dom, why don't you start off the discussion by just talking about capital allocation and the different ways management teams can utilize cash flow for their businesses. You're muted.
Yep, will do. Thanks, Grace. Yeah, so management teams, again, play a vital role in the performance of a business and the stock over the long term. And companies that generate cash flow, management teams have the responsibility of allocating that cash that they generate. And they have 5 ways that they can allocate that cash. They can either pay it out as a dividend, they can repurchase stock, buybacks, they can retain cash, they can either retain it or maybe if they have debt, pay down debt. They can reinvest it back in the business. So that's either maintenance capital expenditures or growth CapEx that would be used to grow the business. And the last one that we'll spend our time today on is mergers and acquisitions. And that's when a company goes out and buys another asset or another company. And the companies below each of the respective options is just an example of a portfolio holding under what we would classify their management team and what they're doing with the cash flow. So speaking specifically on mergers and acquisitions, M&A is typically the most risky endeavor of the 5 options. Typically, what we've seen is, if you just look back statistically, M&A is the most value destructive option of these 5 that a management team can pursue. Typically, they overpay for target firms. They overestimate the value of what they call synergies. That's either on the revenue side, that's the ability to cross-sell, or on the expense side, that's remove duplicative costs of each organization. And then they oftentimes have difficulty delivering on the promises or the benefits of the integration. Some of the reasons why companies may choose to go down this road, sometimes you'll see a company that's languishing behind in their respective industry, and they need to go out and do something transformative. And oftentimes, we might see this in the AI space today, where company XYZ sees competitors using AI to enhance the capabilities of their current company. Company XYZ says, we need to go out and make an acquisition so we can be like these other companies and stay relevant in the space. This results in them going out making an expensive acquisition just because they want to keep pace with what competitors are doing. And then another common one is we'll see a company that's basically just going down the path of becoming irrelevant, but in order to sort of just stay afloat, they'll go out and use the cash flow that the dying business is generating and go out and make a acquisition in some sort of growing industry. Oftentimes you'll see a company that enters into a new industry fail because they have no real expertise in that space. What we look for and what we want to see our companies doing is go out and make acquisitions that are oftentimes in the existing footprint of their business. So they already have some sort of idea of what goes on in that industry or in that business. And oftentimes we'd like to see companies that have large expense synergies. So oftentimes when one company acquires another, there's a lot of back office or public company costs that you can eliminate immediately because you don't need to pay 2 board seats or pay 2 CEOs, things like that. The cost side is a much more profitable and beneficial way to sort of integrate acquisitions versus revenue synergies are oftentimes not as reliable to bank on. So in our portfolio, BGC and Bank of Ireland are 2 recent examples of companies making acquisitions that we'll touch on more later in this presentation. Grace?
Yeah, thank you, Dom, for that segue into our discussion on acquisitions. Peter, on to you. So first on our list is Qualcomm. Can you shed some light on their prior and in-process acquisition?
Sure. You know, as we're looking for investments in our following companies, the mergers and acquisition part is always one of the most difficult because it's very, very difficult to make sense of what a company is doing because we have very limited information on that. You know, in the case of Qualcomm, this is a company that developed the CDMA technology and became the standard for cell phones. And they developed the various levels, you know, 1, 2, 3, 4 in terms of levels of cell phones. And now we're in 5G, for example. So we're 5th generation. And along the way, you got individuals who are both using your chips, in the case of Qualcomm, and others who are licensing their technology. And they became the dominant company. And of course, in their first phase of their life, the first 20 some years, it made sense for Qualcomm to do small add-on investments that complemented their wireless technology. And so they made numerous technologies that were relatively small mergers, but nonetheless helped fill in an area of wireless that they were lacking in. But you know, along came in the middle, like in 2015, Apple, who was paying royalties and buying Qualcomm chips, began to be disgruntled, and their relationship deteriorated, and Apple had stopped paying royalties. And so at that point in time, I think the management team of Qualcomm said, hey, listen, we have the dominant share. It's very difficult for us to continue to acquire additional companies in the 5G and 4G area. So they felt to go on to a diversification strategy made a great deal of sense, and I agree with them. So they looked at potentially in semiconductor areas, but they also felt that automotive and CPU chips would be an opportunity for them, and ultimately, in recent years, artificial intelligence as well. So the Nuvia acquisition was a group of Apple employees who had left, who were developing a CPU or computer processing unit, and it was a natural move for Qualcomm to get into that market. But you know, as you look at the sheet here, you saw that they paid $1.1 billion for the company. The company had no revenues. And so as an analyst trying to evaluate, does that make sense for Qualcomm? It's virtually impossible to make sense unless the management team clearly displays to you what they're doing and why they're doing it. And almost at any time you're analyzing a merger, it has to be in a 2020 event several years later. And of course, that acquisition closed on 2021. And the Nuvia acquisition has been terrific because the new artificial intelligence computers. The CPU is the Snapdragon CPU that NVIDIA developed, and they're taking market share from both AMD as well as from Intel. So there's an example of one that is gone very well. The most recent one was a $2.4 billion purchase for AlphaWave, which is only was announced this past quarter. And so we have very limited information on it. But as you look on there, they're paying $2.4 billion, which is 6 times sales, which is, as deep discount value investors, that's outrageous to us. You know, we recently purchased Compass Minerals, and we paid they had 1.2 billion in revenues, and our purchase from a common stock standpoint was we were buying it at about 400 million. So we're buying things at the opposite end. I mean, literally 25x less cost for us. So it's very difficult to figure that out. But as we move forward here, they're going to be moving into not only the automotive, but the CPU and artificial intelligence is a natural outflow from that, and also getting a stronger hold in the data centers area, which is another rapidly growing area. But in the case of just kind of understand the mergers, it seems to make a great deal of sense in terms of their diversification program. So, Grace, back to you.
Thank you, Peter. Moving to a more recent series of acquisitions, Dom, would you share a bit about BGC?
Yeah. So recently, BGC made 2 acquisitions. OTC Global is the larger of the 2 at a $325 million purchase price, and Sage Energy Partners, or Sage Energy Holdings, was only a $65 million acquisition. The dollar amount is all relative to the size of the current company. So BGC is a couple $1 billion company. So a $300 million acquisition is pretty significant for them compared to Qualcomm. You know, a couple $1 billion acquisition is of a similar size. Again, all compared to their current market cap. So earlier this year, BGC acquired OTC Global, $325 million in all cash. So OTC Global is the largest independent institutional broker in the energy and commodity space. So they deal in over-the-counter derivatives, futures, options, swaps. And so just for an example, say you're a natural gas producer and you want to hedge the price of natural gas because you're worried about the price falling in the future. So today, maybe natural gas is $3 per BTU or BBU. And your break-even cost is $2.50, and you want to just protect yourself in case natural gas falls, you would call OTC Global to say, hey, I'd like to hedge my production cost of natural gas. Can you go out and make us a market and find how much it's going to cost for us? OTC would come back to you and say, here's the current market for your hedge, for you to hedge your production. And then within that, OTC takes a fee based on the size of the contract that they negotiate on your behalf. So in 2024, OTC did about $400 million in revenue, and the acquisition just closed on the 1st of April. And during the conference call, management said that they expect in Q2 OTC to generate about $115 million in revenue in the quarter. So if you just assume that it's a similar amount for all 4 quarters over the next year, that's about $460 million in revenue, or a roughly 15% increase from 2024 revenues, which is a great number. And the BGC's energy business has been growing like weeds in mid-teens to low 20s% over the past couple of years, and this acquisition only solidifies their position in this space. And so the interesting part of OTC is they are a lower margin business. It's in the low teens, call it 11 to 13, 14% right now, versus BGC is in the low 20% pre-tax margin. And over time, management has stated that their expectation is to bring that 11 to 14% up to BGC's current margin of, again, low 20%. You can imagine 400 million at a 10% margin is $40 million. 400 million at a 20% margin is $80 million in pre-tax profit, which that's a significant increase and assumes no revenue growth, which we've already seen that this will happen. And then beyond that, there's going to be additional revenue and potential cross-selling opportunities for them to complete. The long-term opportunity is BGC has their legacy business, which is a low 20%, and then they also have their higher margin electronic business, which is in the mid 30s to low 40s%. And management hasn't come out and said it yet, but the opportunity over time is going to be, we're going to take OTC's 10%, 10 to 13, 10 to 14% margin, and hopefully transition it to that 40% margin business. That's not going to happen this year, next year. That is a long-term 5, 10, 15-year opportunity. But again, when you go from 10 to 20 to mid 30s, that is a significant increase in profits at the business. Sage, on the other hand, much smaller business. Sage is in the carbon credit space. So, for example, ExxonMobil might emit a certain amount of carbon dioxide every year. They are required to purchase these carbon credits to offset the carbon that they emit. They would call Sage Energy, say, hey, we need to buy 1,000 contracts to cover our carbon emissions expense for the year. Sage would go out, make them a market, and come back to ExxonMobil and say, hey, here's how much it's going to cost for you to buy these carbon credits. And again, Sage would take a fee based on the size of the contract. And so both these acquisitions are in the energy and commodity space. Again, it's going to be BGC's largest revenue generating segment by quite a bit now moving forward. And again, this space is seeing high teens, low 20s% growth over the past couple of years. And again, and early indications are that these are going to be successful acquisitions. Pete, I will hand it to you to discuss NVIDIA and their historical acquisitions.
Sure. So the first one we want to talk about is the 3DFX, which they purchased out of bankruptcy court. And it's kind of cool to get some of the history on how this all came about. But NVIDIA came out with their first couple of chips. The one was the NV1 and the NV2. NV1 was launched in the fall of 1995, and there was actually a lot of competitors. But 3DFXX was one of their major competitors, and also as was ATI. And ATI was ultimately acquired, drawing a blank on the name of the company, not Intel, but Intel's closest competitor. But anyhow, when that NV1 came out, it was an absolute disaster, and NV2 was a disaster as well. And the company was literally looked like it was doomed, and the company was running out of assets and had no chance of making it. 3DFX would have been had a wonderful opportunity to acquire NVIDIA, but they assumed that NVIDIA was going to die a slow death on their own, and they could acquire the assets from the bankruptcy court. So they did not make an attempt to take over NVIDIA's chips. It's Advanced Micro Devices, by the way, is the one who took over ATI. So the company decided to pivot, and they took a huge risk. So what they did is they literally fired 65% of their staff, and they made a decision to both design, manufacture, and ship a new chip in record time. And the really crazy aspect of what they chose to do was they decided to use an emulator to skip the costly prototyping step that goes into and go right into mass production. That had never been done in the history of semiconductors, and so it was a very, very risky scenario. But it's when you got 3.5 million chips on a chip, transistors on a chip, and all of them have to work, that's a very risky scenario to take. But anyhow, they were successful with that, and over the next several years, they became the dominant company in chips. And the 3D FX had an awful lot of really great quality people, which they were just able to make them offers, but they were able to buy some of their technology and things at a bargain basement price, and that helped them ultimately become the dominant force in the gaming chips. So in 2006, the company decided that they realized that if you put several GPU chips together, you would get geometric growth in the processing, and so they started moving forward with this process called parallel processing. And their software that ultimately became the dominant software was their CUDA software. And the reason I tell you this is because they had to invest a tremendous amount of money. And from 2008 through 2013, the stock price actually declined about 70%, which was right about the time where we entered. But also in 2013, the Starboard Value Fund came on board as well. And they're known for being raiders and forcing companies to sell out, and so that they make a short-term profit on it. NVIDIA then went on a roadshow trying to drum up support, and they met with Fidelity and several others large holders, and it was not going well at all. But then surprisingly, Starboard sold their stock without any rhyme or reason, and they thought the rest of that was history. But fast forward in 2017, Starboard again got into a situation where they tried to take over a company who was a poor performer, and that company was Mellanox. And it just so happens that Mellanox makes a thing called the Infinity Band, which was an absolute critical item being used for NVIDIA's GPU processing chips. And in this case, Starboard forced Mellanox to put itself on the auction block, and both AMD, Intel, and NVIDIA were part of that. And AMD won the bidding and acquired the company for just under $7 billion. It was a very, very important aspect that allowed them to take a huge step forward in terms of artificial intelligence, and then the massive growth that we've seen in NVIDIA since then. Just on a side note, NVIDIA today reached over $4 trillion in market capitalization, the first time a company has done that. So it's an amazing scenario of the fabulous growth of this business since 2013. Dominic, I'll let you move forward on 5 Point.
Sounds good. The only thing I'll add is I believe if you look at the 3D FX acquisition, they used 1 million shares of NVIDIA. It was worth about 40 million back in the day. I think today it's worth around 26 billion had they held those million shares. So I know Buffett's talked in the past about his one horrible acquisition was when he used stock. Obviously, NVIDIA probably didn't foresee this kind of future, but certainly interesting. Okay. All right. On to 5 Point in their recent acquisition of Hearthstone. This is a very recent acquisition. I think it was announced within the last month or two. So the details behind the transaction, management's plan is all very new, and management has not spoken about their expectations or what they plan on doing with the Hearthstone acquisition. So some of this is going to be a little speculation. Others, it's going to be based on what Hearthstone has done in the past. So 5 Point announced that they're going to acquire 75% of Hearthstone. They're going to pay $59.3 million for it. It's roughly a $75 million valuation. $3 million of the purchase price can be done in equity, and the rest is going to be done in cash. 5 Point has a significant cash balance right now, so this is not an issue at all. And the acquisition fits well into 5 Point's transition towards a more capital light business. Hearthstone is a specialized real estate investment manager and advisor in California, which is exactly where 5 Point, all of 5 Point's locations are. They deploy capital into residential developments. They offer financing structures for home builders, land banking solutions, and then other advisory services. So they have about $2.6 billion in assets under management. So these are institutions give Hearthstone capital, and then Hearthstone goes out and makes investments into different properties or different types of investments. So one way I can envision something like this partnership playing out is Five Point needs $150 million to develop the infrastructure of 1,000 lots at Valencia or San Francisco, one of their existing projects. Instead of Five Point using their balance sheet capital, which they have about 500 million of today, they're going to take 150 million of assets under management that Hearthstone has and use that to fund the build out of the project. That 150 million will get some sort of preferred rate of return, call it 7 to 9% that the investors will return. Five Point will get a management fee because they're going to be the ones developing the project. And then they'll get some sort of upside return. If the property returns 15%, that difference between the preferred return of 7 to 9% and 15%, that might get split between Hearthstone and Five Point. So they might get 2 to 3% of the upside profit from the build out of the development. And this is different than before, where Five Point would pay or use their capital, all 150 million of it upfront, and then they would get all of the return. This way, it's a lot less capital that they're putting up, so it's a lot less balance sheet intensive, but they're still retaining upside of the project. And so I think this can be a really interesting acquisition. The management team has talked about expanding into different areas, whether that's within California or venturing into other states. They did not want to use their $500 million worth of capital to go out and fund this acquisition, fund the acquisitions of future land developments. They're trying to shift to a more land light, that they call it, type of venture. This is exactly what we saw home builders do over the past 2 decades or so, where they transitioned from owning the land that they would build houses on to buying options on the land and then selling the land and building on it, instead of just holding however many hundreds of lots on their balance sheet. They would just have an option, which would be a lot less capital intensive for them. And so if you want to go down a rabbit hole of what this could mean for Five Point over the next couple of years, we already know Great Park is nearing the end of its life. It only has a couple hundred acres left to sell. So that property is going to be done within the next 3 to 4 years. What I think this probably signals is that the San Francisco venture that we've been waiting several years to get underway, management has already signaled that things are moving forward and should be starting in the back half of 2025, first half of 2026. This likely signals that we're going to start seeing building occur on San Francisco relatively soon. And again, instead of Five Point having to go out and do a joint venture with some other builder or selling some of the property to fund the build out, they're now partnered with Hearthstone to basically keep the entire project internally, which San Francisco is the largest property on Five Point's balance sheet. So it makes a lot of sense to try and keep as much of the economics as they can in-house. So I think there's a lot to be seen still, since the acquisition hasn't even closed and we haven't heard management's exact plan. I think the thing to watch out with Five Point as well is this is a $59 million acquisition. They have another $500 million of cash on their balance sheet, plus what other cash flow they generate throughout the rest of the year. It would not surprise me if they have another acquisition in the pipeline that they're waiting to close on. So, I guess we'll see what happens, but nonetheless, I think this has an opportunity to be a really interesting acquisition for Five Point. Pete, anything to add?
Yeah, the only thing that I wanted to add was, I think actually the day after you brought this to my attention, the Apollo, they mentioned that they were going to get into the exact same business. Why don't you mention that? Talk a little bit about that.
Yeah, basically the exact same venture that 5 Point is going into. Apollo is one of the largest alternative investment managers in the world. They are very forward thinking. I think for me at least, it signaled that 5 Point is, the old Wayne Gretzky saying they're skating where the puck is going. They're not just, looking in the rearview mirror. So I thought it's very early confirmation that 5 Point is headed in the right direction.
I want to talk about Bank of Ireland and their two transformative mergers, both the merger of Davy and KBC Ireland Bank. We became familiar with Bank of Ireland, and after I listened to their 2018 Investor Day report, and this was in late 2019, after they had a change of top management. And they laid out a beautiful plan as to how they were going to improve the non-performing loans and the approach of improving technology and other items that were going to help the bank, because their non-performing loans were, even at that point in time, were quite outrageous. But several things happened shortly thereafter. Early 2020, in middle of 2019, Boris Johnson was elected the minister in England, and the Bank of Ireland stock, which had $10 per share in tangible book value, dropped off and had dropped from $6 per share to $4 per share. And then 7 or 8 months later, we had COVID, and the stock price dropped in half again. So now it's trading at under $2 per share. And we're looking at this thinking we can buy $10 of tangible assets for $2. We're thinking what a great investment this is. And that's when we made our initial purchase in Bank of Ireland and continued doing that for quite some time. And also the Republic of Ireland had begun selling their shares that they acquired in the bailouts from the global financial crisis and stuff. So they had another opportunity to use some of their money, which was to repurchase their stock. So in my opinion, I was a little bit puzzled as to why they weren't repurchasing some of that stock directly from the Republic of Ireland. Within a few months of each other, KBC Bank decided to move out of Ireland, as did Ulster Bank. And so we literally went from 5 major banks in Ireland down to 3. And so they bought those, what they believed to be at a very advantageous price. And then Davy Company, which was the wealth management business, the dominant wealth management business in Ireland, became available, and they made the opportunity to purchase into that. Even now, looking back, it's very, very different. The company is doing extremely well, but it's hard to say, how they're benefiting from those two, because they don't break out their numbers well enough that you would know exactly how the Davy is performing relative to their investment, or their KBC Bank is doing. But they bought the non-performing. They purchased the performing loans of KBC, and Bank of Ireland since then is moved up from its lows of under $2, and it's recently hit a high of about $14. And they've now moved to a scenario where they're using their cash to distribute in the form of cash dividends, and that will continue to move forward. And relative to our initial purchase price, we're getting substantial dividends, and we're quite happy with the direction we think that'll take over the next several years. Dominic?
I have nothing to add. Grace?
Thank you, Peter, for that. We'll now get into some acquisitions that were not so successful. Tom, can you walk us through what has happened with Compass and Fortress?
Yeah. So back in 2021, Compass, they already owned a 5% stake in Fortress Fire Retardant. They made a more significant stake in the company, brought their ownership stake to 45%, and later on acquired the remaining 55%. So Fortress, it's a fire retardant business. The goal of it was Compass's business is very seasonal in that in the winter season, so call it Q3 and Q4, their business is very strong because it's the salt business. It's when roads need to get de-iced, so their business is very strong during those periods. But then in the spring and summertime, their business is very slow because you don't need ice to melt the snow or ice off roads. So they wanted to go down a path of reducing the seasonality in their business, where fires typically happen in the spring and the summertime. So you would need fire retardant in the spring and summer. So now you have a business where you've got 4 quarters of relatively consistent or more consistent revenue generation. And the other part is Compass has a great salt lake operation that uses magnesium chloride, and one of the chemicals that goes into a fire retardant is this magnesium chloride. So they thought it would be a good fit to use leftover magnesium chloride in the fire retardant and be able to have a low cost way of manufacturing fire retardant. The issue was this hadn't been done in 20 years. There hadn't been a new entrant in the fire retardant business in 20 years. And during an inspection, the North American Forest Service found that there was significant corrosion in the planes that Compass and Fortress had their fire retardant in. It then led to them canceling the contracts. The North American Forest canceled their contracts with Fortress and Compass. And then a year later, basically Compass shut down the business. I'm going to say the good part is these actions were done by the previous management team. The investments in both the lithium project and this fire retardant business were done by the previous management team, which is why one of the reasons we were comfortable making the investment is because those that had previously made the poor capital allocation decisions are no longer the ones in control. In addition, the current management team is basically writing off and eliminating the poor performing businesses and not spending the good capital that the salt business is generating on these bad assets, the lithium project and the fire retardant business. And instead, they're now preserving cash, paying down debt, which they recently did. And so the new management team is doing exactly what we want to see. And again, one of the reasons we are comfortable with the investment. And so they took a write-off of basically their entire investment in the second quarter. And now you'll see that the selling, general, and administrative, basically the costs that were associated with the fire retardant business, those are no longer going to occur. So you're going to see a lower cost line at Compass as well moving forward. So all in, obviously it would have been better to have a business that has 2 high quality businesses, but it's good to see the current management team not continue to throw good money after a poor investment and just basically move on.
It seems like, when you go through your original logic as to why they made their decision initially, it sounds very logical and it sounds like it would work out incredibly well. So it just goes to show you that there are no guarantees, and something that seems like such a no-brain decision on behalf of management can turn into such a disaster. The Compass Minerals from 2004 through 2014, they grew the business at a compounded rate of 22% annually. So you had an absolutely fabulous business. From 2014 through 2024, they did an incredible job of diversifying that business, and the stock price went from 95 to 7. As unloved and unwanted value investors, we were able to find something that of tremendous value that had been thrown into the scrap heap.
Bringing it back around to NVIDIA, Peter, can you walk us through one of their failed acquisitions?
Sure. And this is NVIDIA, after their tremendous success with Mellanox, the SoftBank decided they wanted to sell their ARM business, which worked with a number of semiconductor companies in helping them design chips. And so they came out with a deal to purchase the company for $40 billion, which was a combination of both stock and cash, and sounded terrific, except that all the companies who also worked with ARM, such as Intel, Apple, and many other semiconductor companies, the idea that NVIDIA would own that and own that intellectual property that could be worked against them, they all started complaining to the various compliance throughout the world, and ultimately the deal was nixed. You know, as a value investor, it just seems insane to me that someone is going to pay $40 billion for a business that only does $2 billion in revenue. But as I said, I don't necessarily know their understanding of it, but anyhow, it looked like it wasn't going to go through. It didn't go through, and ended up costing NVIDIA $1.25 billion in the ultimate breakup, and also a tremendous waste of the management's time through that 2-year period of trying to get various nations of the world to approve the merger. Anything you want to add, Dominic?
The only thing I'll add is I don't think I ever got a phone call from you saying, I think this merger has the potential to go through. I think from day one, you said this merger is very unlikely to ever happen due to regulatory concerns. So interesting that the management team would even try and go down a path like this.
I definitely, I remember saying that to you, but the reality is I also, there's so much that I don't know that I'm not privileged to. So it's always a guessing game on your behalf when you're looking at this stuff, because you're looking at it with very, very limited information. 2020 hindsight works really well, though. I'm really good at that, by the way.
Only had a crystal ball. On to our last failed acquisition, handing it back to you, Peter, again for Qualcomm.
Sure. As we'd mentioned before, Qualcomm in the middle of the last decade decided that they wanted to go on a process of diversifying, since they had dominated the cell phone market, and since they had so much market share, they wanted to use the cash they were earning for that to move into some other areas. And the natural progression for them was to go into the semiconductors in the automobile area, where they already had some business as well, and they wanted to strengthen that. And that was also at a point in time where the U.S.-China relations started to deteriorate, and the U.S. had nixed several Chinese mergers, and so the Chinese regulators would not approve the merger, although I believe it would have been a wonderful and very sensible merger for them. And once again, the breakup fee is very painful and a lot of wasted time. It was a $2 billion breakup fee that happened when they threw the towel on NXP. If there is any good news from the scenario, that is that the $15 billion that they borrowed to purchase NXP, they did a major share repurchase of Qualcomm stock at about $65 a share. So they were buying back their stock at ridiculously low prices. And so I think they benefited tremendously by that. Once again, looking in the rearview mirror of what happened in the past.
Dom, anything to add here?
Nothing to add there.
Well, thank you for that informational discussion. We're now going to move into the question and answer portion of the call. So if you do have a question, feel free to pop it into the chat box, and Dom and Peter can answer those as we see them come in.
I will ask a question while other people start thinking of their questions. Peter or Dominic, always like to ask this one. Of all the companies that we own in the portfolio today, which one are you most excited about, and which one would you be adding to if you had capital to invest?
I can start, Pete. Talked about it on this call. I continue to think BGC is in a very good place right now. There's also regulatory tailwinds that we could be seeing from them over the next couple quarters. Their recently launched FMX exchange thus far has done fine about what I would expect them to do. And then the potential from these two acquisitions, I think, is very high. So I think clients are pretty full on BGC, but I continue to think that's one of the best investments.
And in my case, I would go with Tri Point Homes, which we added to our position over the last week. As I look at many of the companies we own, and you look at asset allocation, I believe they do a marvelous job. They don't pay a dividend. They've been aggressively repurchasing their stock. They've been consistently growing the business at about a 15% rate. It trades at a very reasonable multiple. They've been Home Builder of the Year several times, and I believe there's the best alternative for many individuals instead of trying to buy a home in the unique housing market we have now. It's very beneficial to build from scratch, and they're also in 13 states that are good growth areas. So Tri Point Home would be one that I would point out. But you could, if you said let's add another one, I would. I love what's going on with 5 Point Holdings as well, real estate oriented as a landowner in California. But while they're in the same area, same home building area, they are actually two very different types of businesses.
Thanks, guys.
Give it another minute in case anyone's typing in a question.
I have another question. On that early slide, we talked about the 5 different methods of capital allocation, that the role of a CEO is to allocate capital within the business. And Dominick, I think you said that M&A is probably the riskiest of those 5 capital allocation decisions. Do you think one of those is the least risky, or your most preferred method of to see a CEO allocate capital?
I think it's a case-by-case basis, because if the stock is cheap, then your preferred method of allocation is going to be them buying back stock. But if their stock is expensive, then you'd rather have them pay out the cash and dividends. In the case of retaining cash, what we've seen at 5 Point and Compass, they have a larger debt balance than what we would prefer them to have. So them retaining it to pay off debt makes a lot of sense to them. Since we are in the active investing, buying discounted value stocks, I say by and large, if I were to just have to pick one of the 5, buying back stock would most likely be the most accretive of the 5 transactions, just because we believe their stock is already undervalued, and thus them repurchasing the stock should likely be the best rate of return that they could generate from any of the 5. The thing that would be, I would say, concerning to us is if a company that we think is very cheap goes out and makes an expensive acquisition with their stock. So instead of paying with cash, using their stock to acquire another company, that would be probably the number one transaction where I would be most concerned about what the management team is doing.
So when we purchased Compass Minerals earlier this year, my major concern was their debt load and the refinancing of that, because it was coming due in a couple of years. And during the first quarter, they had really strong cash flows, which was terrific. They paid off a significant amount of their debt, which is exactly what we were hoping to see there. But I'd say debt is the thing that scares me so much in a case like Compass Minerals. But the stock seemed incredibly inexpensive. And the management team did exactly what we'd hoped they would do, and we hope they continue that process. So, as Dominic said, there is no right answer. Every situation is different, but the repurchasing of stock when the stock is really inexpensive, we love seeing that. And very often, that's the reason we're buying a stock, is because we believe it to be incredibly inexpensive. And as I'd mentioned, when Bank of Ireland was trading at $2 a share and his tangible book value was at $10, I'm thinking, why isn't the Bank of Ireland buying back their stock as well?
We had a couple questions just come in. First one being, what impact, if any, do you see new tariffs having on the mergers and acquisitions market?
I'm going to say thus far I haven't seen really any impact, and you've got different and conflicting news come out what feels like every other week still. So I don't think management teams are really basing their capital allocation decisions on what the tariff news of the day is. They might, we've seen a lot of them start to reconfigure their supply chain. Maybe if they can make an acquisition to diversify their supply chain to other countries, they would do that. But by and large, I haven't really seen any impact to the M&A market on tariffs. I actually think the M&A space is relatively healthy given how much market volatility we have seen.
And I'm in reading the Wall Street Journal each morning, the number of mergers in the artificial intelligence area is just never ending, and the valuations of which they are making these transactions just is mind-boggling. That I just look at them and say, I have no clue what the heck is going on there. It just seems that the numbers are so outrageous.
Their question was, how will movement, if any, with the Federal Reserve with interest rates impact real estate related holdings?
I'm going to say for us, we own a national home builder, and the national home builder versus your local regional builder, like a Tri Point, is at a much greater advantage versus them because they are able to use their financing arm to basically buy down rates for customers versus your local home builders have you go through your local regional bank where you would be on the hook of paying down that interest rate. So right now, I'm going to say higher rates are a net advantage to Tri Point and the larger home builders compared to your local developers. It's also the reason we haven't seen really any secondary transactions. The secondary transaction of housing is just relatively non-existent because people are not moving out of a 3% mortgage into a 7% mortgage. So again, when you can go from a 3% mortgage that you're currently in and maybe go to a home that Tri Point built and only go from a 3 to a 4.5, you might do that. Whereas going from 3 to 7 is probably out of the question.
Peter, anything you want to add?
Nope, Dominic did a great job of explaining that. I agree with him.
Give it a few more seconds in case anyone's finishing up a question. All right, if there's no other questions for tonight, this will be the end of our quarterly investor call. As a reminder, for the next quarterly call, you can send in questions you'd like answered by our team via email prior to the call. You can just email any member of our team with your question and we'll be sure to address them. You will be able to replay a recording of this video if you want to go back and rewatch within 24 hours on our website and YouTube. Thank you all so much for joining us tonight. We really appreciate you spending a bit of your Wednesday evening with us. So enjoy the rest of your night.